Hello, everyone. My name's Andrew Castleberry.
And he's with Austin Rowland.
I was going to introduce you,
Okay,
but
yeah,
if you
well.
don't want to be introduced, that's fine. But no, what we're talking about today is really what is the point of diversification? Because we get this question a lot. Also, I'm sure it comes up in your meetings. I know it comes up in my meetings pretty regularly. Not so much in down market years like a 22. Everyone loves diversification in 2022. But in 23 and 24 specifically, I think I get the question a lot now is, hey, why am I diversified? Usually that's followed by, have you seen NVIDIA? And then the conversation becomes, why aren't we just in these big key names? Why are we just not in the US? And what we wanted to talk about today was really why you diversify, look at a couple charts. We have essentially a white paper that's done fairly recently on diversification we want to go over. We'll link to that in the show notes. But we really just want to have a discussion around that.
Yeah, what's the point?
Yeah.
Well, Andrew, I think something helpful to start us off with would be just give us a short narrative of what has happened in the markets over the last 20 years. So 2000 to 2024, there's a couple different periods of outperformance, underperformance by some pretty key U.S. sectors. For instance, you mentioned U.S. tech the past few years. Yeah. Have you seen NVIDIA? Have you seen Amazon, Apple, Microsoft?
Have you heard of Apple? Like, do you know that exists?
But in the early 2000s, tech was not what they are today. So just give us a short narrative of what that looked like.
No, yeah. So, I mean, so again, and I think a whole big argument, and something we'll get to a little bit later, when you talk about diversification, and one of the things that I think irks people a lot is you can cherry pick time periods. So you can say, all right, well, the last decade, I think you would be hard pressed to argue against U.S. market dominance. Like U.S. outperforms international, large cap U.S. outperforms small cap U.S. over the last decade. Big tech is really going to be a predominant factor. So if you look here, you can essentially see U.S. equities from 2009 to 23 in blue, which is a pretty handy gap against everything else at that point. And predominantly, if we were to pop the hood in U.S. equities, what you're looking at is U.S. large cap being the kind of main provider. I think you saw U.S. small cap, and I'm pulling this up right now. It outperformed U.S. large cap from about 2009 to like 2013, 2014, give or take there. And then as you saw kind of that economic cycle start to mature a little bit, really since like 2013, 14 on, it's been large cap across the board, specifically dominated by large cap tech. That's been the key names. However, you kind of go the 2000s decade, so 2000 to 2010, that's where you saw the NASDAQ had a market peak, I think in like early 2000, and then was in essentially a 10-year drawdown. So you had large cap tech and tech in general just get obliterated in the 2010s. And you had periods where international outperformed for a stretch of period from like 2003 to 2007. You had small cap outperform large cap tech. So for U.S. equities, and specifically large U.S. equities and really, really tech U.S. equities, 2000s decade was terrible. I mean, you saw absolutely garbage returns. But again, it's cherry picking. You can't, I think one of the points we want to talk about today is I can't necessarily say, oh yeah, the next decade is going to be large cap tech outperformance, but I also can't deny that if you were in a diversified portfolio in the 2010s, you had 2 or 3 portions of your portfolio that dramatically underperformed, but then in turn, you still had 2 or 3 portions of your portfolio in the early 2000s that underperformed. It's just the underperforming entities in the teens were small cap and international. The underperforming entity in the 2000s was U.S. large cap. So that's what we're kind of talking about. But I think if you had to look at the last 20 years, that's what we're talking about is a really differentiation between regime changes in what portion of your portfolio is leading the race and what portion of your portfolio you're really starting to question, why the heck am I doing this?
Yeah. And I think the next question then becomes, okay, Andrew, if that's the point, if that's what you're trying to say is that during different time frames, different sectors or different asset classes are going to do better than others, then I guess it begs the question, well, how do I know which one's going to do which? And I think what the white paper is saying, and what we're trying to also come to the conclusion of, is that's not the point. You're not trying to guess which outperforming asset class is next.
Yeah, and I think the argument I think we would make, and the argument I think this paper's making, and I think the argument everyone's making for the most part, is you just don't know. Like, you don't know what the next 10 years holds. Like, you ask someone December of 99, hey man, do you want to diversify out of tech, because I'm pretty sure you're about to go through a 10-year period where it's going to be the most abysmal asset class you've seen in your entire life. And they'd be like,
you're insane.
Get out of here.
Yeah.
What? That's dumb. But no, so I like, that's hyperbole, but it is one of those things where 10 years is a long time. For a lot of market combatants, a lot of market investors, 6 months is a long time, not to mention 2, 3, 4, 5, 10 years. I mean, that is a long time period. And I think what you have to look at is, when we're talking about diversifying and when we're talking about building a portfolio, you're really having to move the conversation away from, all right, what is the hot asset class right now, to what's your target goal? Like, you want to reduce volatility, so you want the least amount of up and down and the most amount of future potential. How do you do that? And I think how you do that is build a diversified portfolio. You mitigate the ups and downs, and you maximize the return for any given asset allocation. So when we kind of look at it here, what you might say is, all right, if we look at a diversified portfolio compared to like a U.S. equity specific portfolio, well, on 1 year, a 1 year rolling return, a 5-year rolling return, or a 10-year rolling return, U.S. equities on 1 year could do worse than diversified, or they could do a lot better. On a 5-year, they could do worse, or they could do a lot better. And on a 10-year, they could do worse and a lot better. Now, the point is, you can have negative returns on a rolling 10-year if you look just U.S. But if you look at a diversified portfolio that has large cap, small cap, international, a little bit of fixed income, on any given rolling 5-year period or in any given rolling 10-year period, you have a positive return. So it caps the upside, but it also caps the downside. And that's what you're kind of investing for. So the point of diversification isn't trying to say, I want the maximum return every single year. The point of diversification is, I have a target in mind, and I want to start implementing a goals-based investing model where I say, hey, I want to retire at 65. I want to live on this. I want to be able to do X, Y, Z. How do I get there with the road of least resistance? And probably, how do I get there with the highest probability? And that's where diversification, I think, comes in. So, I mean, to that point, what would you say to someone? Because, again, we can talk about this all day, because I think we both generally agree diversification is a good thing. What would you say to someone that just says, well, why would I not just want the best return? And why would I not just kind of go out guns blazing every single year for whatever's the hot commodity? And then what's the downside or risk of that?
Well, I would say, if you're asking the question, why should I not want the best return? That's not what we're saying. We're not saying you shouldn't want the best return. What we're saying, and I think what diversification is trying to prove to you, is that you should want the best return that you can have the most guarantee of having. Because
that is
shooting for the best return is a great idea. You should always try and maximize the potential of your investment strategy, but you can't be sure that any specific asset class is going to do what you want it to do, or that is going to outperform any of the other asset classes over a given time frame. Mm-hmm. And so you should shoot for the return that, one, I think you mentioned goals-based investing approach. And I think when a lot of people, we do retirement planning, so we're financial planners. We're helping people not only with their investment management, but all aspects of their financial life. And I think sometimes people are confused that when we're creating a portfolio, we're not trying to beat every other asset class or every other investment strategy out there. What we're trying to do is make sure that, hey, you've told us that you would like to retire here. This is how much money you'd like to spend. This, family is really important to you. Vacations, these are the things that you'd like to do. You really want to travel. We're going to try and build a portfolio that allows your resources to give you the opportunity to do all of those things. And that's what's important is the fact that you can do all the things you'd like to do because your return allowed you to, not that you beat all other investment returns out there.
And I think to that point, I think it depends on the type of investor you are as well. Is like, all right, so we are talking about like in show prep for this, where's diversification kind of the benefit for? And like you have younger individuals that they don't care about diversification. They're 25, they're 28, they're 30, and they might say, hey, I just want to get the absolute max. And we've had conversations with investors in meetings where it's like, hey, I'm young, I can take volatility, I want the absolute maximum risk, I want the maximum return. And if that's the type of investor you want to be, there's nothing wrong with that. I think in that environment, if that is your goal, so if your goal is, hey, I don't care about retirement planning right now, I'm at a point in my life where I want max return, period. And you know you can stomach a 70% drawdown in something and not sell, which we haven't even gotten to the behavioral side of this at this point, what we're going to get to. But I mean, for that investor, then yeah, diversification might not be the answer because that's not what you're looking for. You're not looking to round off those sharp edges of the market. What you're looking for is maximum potential growth, which involves maximum volatility. Like it's the risk reward trade-off. You can't limit your risk and then expect the same reward. Like they're gonna work hand in hand together. So with kind of the diversified portfolio is you get to someone that's, hey, this is the money I want to live off of. This is the things I need to have some sort of real built-in plan around. I can't just shoot from the hip and say, hey, it's all in NVIDIA this year, all in Tesla next year, all in Google this year. Hey, I'm going to jump to energy in 2022. I'm going to do X, Y, Z, because the reality is, one, you manage to hit all those right. You're the best trader that's ever existed, period. But two, it takes a lot of trading and it leaves a huge opportunity for error rather than setting something up that says, all right, I have things in my portfolio that'll work in this environment. I have things in my portfolio that'll work in this other environment. I have things in my portfolio that'll work in this other environment. Like I think a regular diversified like 60-40 where you have 60% equity, 40% bonds is a great example. Over the last 5 years, you had bonds work really well the first half of 2020 when rates were dropping. Mm-hmm. You had equities work really well in the second half of 2020, and you had equities work really well in 2021. You had neither work well in 22. You had equities work well in 23 and 24. And we're in the position where bonds are starting to work well in the second half of 24. So you had different parts of your portfolio kind of doing different things. And we're in a position where I think like you have a really good outlook maybe for fixed income in the next year if rates start to drop again. So it's one of those things where it's not like 100% of your portfolio is trying to hit at every single moment, but you had enough balance there to where you were able to smooth out some of the harsh edges over the last 5 years to kind of target a more regular performance. So when we look at like an extreme example of this, I think the 2000s decade is where everyone goes to. On an extreme example of this is you go through the top of the dot-com bubble, the immediate market drawdown over 3 years in the U.S. markets. Then you go into that bubble leading up into 2008, the financial crisis. So you go through 2000 and 2010, and you have a negative return in U.S. equities, where you go through that same period in a diversified portfolio, and that return ends up being better. Now, this is where I say cherry picking, because you see this chart all the time and you're like, diversification is a win-win, everything works out, but because this is an extreme decade. But that's where I say like a decade's a long time. Even the last 5 years is a long time, because a lot of this isn't just investment based. You can say, hey, well, I could have sat in the NASDAQ for the last 20 years and outperformed, but are you willing to see your account be below market highs for a decade? Are you willing to go through a financial crisis and continue to see your account be down 50, 60, 70% Will you hold a stock like Nvidia in 2022 when I believe it was down 70%? Like, it's one of those things, in order to get that return, yes, you can say, well, if I had just held it, but that isn't a linear road.
Yeah.
You see massive swings. So if you have invested $500, $600, $800,000 and you're seeing a 70% drawdown in 1 year, it's easy to say, well, yeah, I'd be an aggressive investor now because you can see Nvidia had one of the most historic returns out of that we've ever seen in market history. But would you have said that when your $800,000 account was what, $200,000? No, you would probably be vomiting uncontrollably for 3 months straight. I know I would. The sheer stress of that would be an absolute nightmare.
A lot of it depends on where you're at in life and what your goals are. I mean, if you are 25 and you're picking, investments for your 401k, you're in a very different position than somebody who's 55 and you're thinking about retirement, or a parent who's 45 and their kid's going to college in 3 years and they're trying to invest for college. Very different situations, very different time horizons, very different risk profiles. And you think about a few weeks ago, we had, I believe, what it was, a 9% drawdown,
like 8 or 9, something like
8
that.
or 9% drawdown. And shortly after, the market starts to recover a little bit, not a whole lot of questions from clients about, hey, what's going on? Is something wrong? Because it was only a couple weeks. Most people probably didn't even notice their accounts doing that. But in 2022, when the market is, down for how long? The entire year?
Yeah.
What were those conversations like?
Yeah, and so perfect point. The S&P was down. So a few weeks ago, August 5th, I think was the bottom, give or take. S&P was off its 8.5% off its high. The NASDAQ, so the more aggressive tech composite that has a higher allocation of big tech, it was down 13% off its high. We go 3 years. So we go the bottom of 2022. The S&P 500 was 20% off its high in bottom of 2022. Well, technically the bottom for the S&P was 24% in October. The bottom for the NASDAQ was in December of 22, but it was 34% off its high. So, I mean, you're looking at a 34% drawdown. We do Nvidia, just to kind of bring that down to the same place. Nvidia was percent off its high. Let me do this because that's duplicating that. It was 66% off of its high.
In 22.
In 22. And then proceeded to have that massive drawdown. But I mean, this year alone, it's had, in August a few weeks ago, it was 25% off its high. So, I mean, you see a massive amount of volatility in one of the best performing stocks over the last 2 years we've seen almost ever. And again, to your point, it depends on, again, ultimately, it comes back to that goals-based investing. What is the goal you have for this money? And where I think most people probably come down on is, all right, I hear this a lot, is I have my play money. That is I'm going to try and hit a home run every single year. If you're anything like me in that account, you strike out way more than you hit home runs, or you hit a home run and then immediately strike out with all of the proceeds from it. And then you have the money that's like, all right, this is
guilty.
This is my serious. Peloton did me in twice. This is, which is really embarrassing to say that I went back. So, but this is in no way, shape, or endorsement of individual stock picking, by the way. But you have then your serious money, and that's the money where you say, all right, we need to craft a strategy, stick to that strategy that provides long-term benefits. Because again, you're going to have periods like a 2000s, you're going to have periods like a 1970s where you do see just abysmal markets for extremely long periods of time. And you're going to have periods like the 80s and 90s where you're going to feel a little bit left out if you're not in those top names. But you have to know, when we talk about retirement planning, we're not talking about the next 5 years. We're not talking about the next 10 years. We're talking about the next 20, 30, 40 years of your life, where you're starting to take income from this portfolio. You need it to be sustainable. And I think to that point, what we get to in this next chart is having that mindset, because it's not just the growth mindset, but it's also the I need to be able to pull income from this. And you get into essentially a sequencing risk, a distribution risk. And if you have that high level of volatility in your account, it can be extremely detrimental. And again, I want to re-stress this point. I think this idea is something that when you're planning for retirement, you can do at any age. But really, I think for your younger investors that can lean a lot more aggressive, you can still be diversified even in like a concentrate. So even if you're like a young investor, you might say, all right, well, I still want to be super aggressive, but I want to be diversified. So maybe rather than spreading out between stocks and bonds, you're all stock. And maybe you do lean a little bit more US and you lean a little bit more mid and small cap that do well, a lot more volatile, but they tend to do well on over longer periods of time. So there's ways to add diversification into your portfolio and still be extremely risky. You're just not taking on that single concentration risk of what if it came out that Nvidia ended up being Enron. I do not think that's the case, but you always have the risk. Or if, hey, CEO suddenly gets ousted. I look at Chipotle and Starbucks earlier this week. Chipotle's CEO was not ousted in the sense that he just went to Starbucks.
Sure.
Chipotle's stock sold off ridiculously just from a CEO move. Like nothing fundamentally changed about the business. You just had a single company concentration risk. So there's always going to be things where a board decision, something that you truly have no control over.
A political event, just literally anything.
So even when we talk about diversification, it doesn't have to be, hey, we're really mitigating a lot of that return potential, but we're just trying to mitigate maybe the single stock risk that isn't something market related, isn't something economic related, but something that could be as simple as
for younger investors.
Yeah, for younger investors, it could be something as simple as a CEO got caught doing something negligent and was ousted, and suddenly that stock's performance dropped down. But I wanted to look over this chart now because this goes over essentially, and Austin, you were telling me about this chart earlier. 3 different scenarios. So Austin, if you'll run through what this chart's showing us, and
so
I'll zoom in for the listeners here.
Scenario number 1, all 3 of these lines, you see the blue, the neon green, and the pink color, they're all going to be the same 6.8% return. But in this portfolio, the 3 different scenarios are different amounts of volatility. So the return's going to be the same. One of them is just a steady Eddie 6.8% return. The next one is going to be a 6.8% return with a little bit of volatility. You know, it's moving up and down a little bit. And the last one is going to be a 6.8% return with a lot more volatility. Now, what's the difference? It's all 6.8% returns, right? The answer is no, specifically when you think about somebody who is pulling from this portfolio. So if you're somebody who, let's say you're retired, you're using, the hard work and investing and saving and everything that you've done to build up to this moment, you're finally reaping the benefits of, which is what you should be doing. You're withdrawing from your portfolio. You're spending the money on all the things that you enjoy. The difference is, let's say you are invested in NVIDIA, for instance, and it has one of the drawdowns that Andrew just mentioned. Well, when your bills are due that month, when you're going to the grocery store, when you're paying utilities and you're doing all of those things, you don't really decide, hey, I'm going to wait for NVIDIA to come back, or I'm going to wait for the S&P 500 to come back before I buy these things. No, you're pulling from your account for daily needs and vacations and whatever else you need to purchase. Whenever you do that in a volatile market, you don't have the same recovery experience that somebody who's steadily invested does, because it doesn't have the comeback that other investors experience. The page prior, there's another graph. Andrew doesn't need to scroll there, but it shows the recovery percentage needed to make up for a specific loss. So if the market is down 20%, then it needs to come back 25% for you to get to the same spot. So if the market drops 20% and you're pulling from your portfolio, you don't get that 25% recovery.
No, and so this is assuming too, so with this 25%, this is assuming market drops 20% and you have taken no distributions.
You don't do anything.
So you still have same principal amount. So you put in, I'm going to do $100 because that's easy for me to do math wise, and I'm still going to botch it. So you do 100, you drop down to 80. Well, you need that 80 to return 25% to get back to 100. That's assuming when it was at 80, you also didn't buy groceries.
Correct.
So you didn't take it down to 75. If you took it down to 75, well, suddenly to get back to 100, you need more than 25% return.
I wasn't going to try to calculate what it was, but I knew it was more than 25.
Listen, I am a firm calculator guy.
Yeah.
If I don't have a calculator, I don't trust myself. But that being said, so when we look at this, this is where, and this is for, like I'd say probably the retiree is super important because life doesn't stop for volatility in the market.
No.
You don't get to pause needing to pay your property taxes. You don't get to pause eating. You don't get to pause doting on your grandkids. You don't get to pause anything in your life because the stock market decided to sell off on something that you have no control over. So what you do have control over is setting up your plan good on the front end. Or well on the front end, well, setting it up well on the front end.
I don't know. I'm not an English major.
And then limiting your volatility, because when you get into retirement, kind of to Austin's point, you see this return here that might have the same dollar return but slightly more volatile in pink or green. You end up with significantly less at the end of your plan. It is really one of those things that can be remarkably detrimental for you long term. So, I mean, to that point, again, it really stresses the trade-off of saying, all right, I'm fine getting maybe a slightly lower expected return, but that doesn't necessarily mean I'm any less successful. And I think that gets to the next point I wanted to make was, how do you view success in this? Is your success your investment return? Is your success how well you sleep at night in retirement or going into retirement? Is your success knowing you're on track for your plan? I mean that's a big thing. So like for some, like a young investor, their success might be investment return. And if that's the case, then yeah, diversifying into something slightly more conservative might not make sense. But if success is, hey, I want to limit any sort of downside, or hey, I want my plan to work, and it's not the number, it's not, hey, a 10% average annual return or an 8% average annual return. And if you get to the end of your plan and you had a 9% rather than an 8%, but it was a rockier road, are you any more or less happy? Does it matter to you at that point? So again, you have to really define the scope of what success is for you at that point. So Austin, what else did you want to look at in this kind of white paper before we start to kind of wrap up this idea?
There's a ton of different graphs. I think one of the more helpful ones may be the international chart here. Yep, that one right there. I think that one, that if you were with the influx of social media and personal finance,
like,
education,
where are you going with this, Austin?
Well, basically what I'm saying is there's a lot of stuff out there, LinkedIn, TikTok, Instagram, even just articles written by Wall Street Journal and places like that. People will just say, why would I not just invest in one S&P 500 fund? Mm-hmm. And if you're 20, 30 years old, you probably don't remember what the early 2000s looked like, but this is it. This is what the early 2000s looked like. And if you're the S&P 500, you're actually dragging. And this is, again, cherry picking a specific time frame. It is the last 20-something years.
And this is earnings growth, too. So, I mean, like, this is why you're looking at companies' earnings. So you saw stock performance mimic this fairly well as well. But, I mean, even on just a company's growth aspect, international has its periods where it does really well. Like, you see this period right up here, which earnings were better, and in turn, market performance was also better at that point. Again, you have more volatility, and the U.S. has really dominated since then, but it is a point where, like, if we come up here, I think this chart does well as well, showing like equity returns. If we go through 88 to 93, international killed it. If we go 94 to 98, international killed it. That's 94 to 98 is kind of nuts, because that is also a great period for U.S. markets, and emerging market international did really, really well. And then you saw 99 to 2010, emerging markets eventually rocked it. So, I mean, you're looking 88 to 2010. If you were an international investor, you did really, really well. Not negating that U.S. didn't do really, really well, but you also did really well. And then 2011 to 2023, U.S. did really phenomenally and has been gangbusters. And again, that's where memory sets in. It's like, all right, well, why would I do international? I'm like, well, because for 2 decades they gave great performance for you, just hasn't been this decade. And I think ultimately it comes back to, and this is where I want to wrap up on this, Austin, but diversification doesn't necessarily mean also sitting on your hands.
Nope.
So when we talk about diversification, really in the scope of building a portfolio, and I'm going to use like a 60-40 portfolio, so someone that's balanced, but we kind of hit on like an aggressive portfolio. So actually, scratch that. I'll jump to an aggressive and we'll go over. So if we had an aggressive diversified portfolio, you'd be all stock. You might have right now most of it in large cap US. You might have some in small, mid-size US, and you might have some in international. But that isn't stagnant. So you might have, let's say, 60% large US, 30% mid and small US, and you might have 10% international. Well, if we start to see a shift, maybe we see like some weakness in the US or like those start to change, you can ratchet that percentage up and down. You're still diversified. You can increase the international a little bit. You can decrease the US a little bit, move it a little bit around, and you're still diversified, but you're not necessarily moving up or down on the risk cycle. You're just moving up and down on where the opportunities are. Now, that's still remarkably hard, and it's done very incrementally. And you're still going to have people argue, I think, that you don't even do that with a diversified portfolio. And with a conservative portfolio, you can do the same thing. You can ratchet up bonds at some point in time, ratchet down equities, change what those allocations are, like what stocks you're actually invested in. Because again, most of these are fairly long time periods. So you don't necessarily have to say, oh, well, I need to have 30% international because it worked in the 80s when it hasn't worked since 2010. When in reality, it's like I still want to have international because it can protect. Like I say, fourth quarter of 2022, international outperformed US by like twofold, which is nuts. So you still want to have some in there. But it doesn't need to be nearly as huge of an allocation portion as it was at times. But that's also not going to say it's not always going to be like 10%. You might push it to 20, 25, 30% in periods where international really has some legs to it. But it's one of those things, even in that side, you're still limiting your risk. You're still crafting that portfolio for the long-term goals. But what you're doing is trying to say, all right, within that framework of diversification, I can still change how my assets are allocated in each one of those fields to try and maximize. So I can still, out of the large cap sleeve, how can I maximize that sleeve? Out of the small and mid cap sleeve, how can I maximize that sleeve? So by no means am I saying, hey, a diversified portfolio is some guy sitting on his hands doing nothing, but it's not going to be, I'm doing 100% this, 100% that. It's you have to work kind of on small little edges.
Honestly, I think something that is attractive to a lot of investors today who, maybe they're retail investors, they don't know everything about the stock market or the bond market or any market for that example.
The farmer's market.
Any market, period. I think one of the attractions to a very simple S&P 500 approach is it's simple. They don't have to research what funds they should be using for international or what funds for bonds or what funds for this sector or that sector or anything. So it's easy for them to say, hey, somebody said the S&P 500 has done well. Let me just pick an S&P 500 fund, put it in that and forget about it because it's less work. It's less,
and that can be for like your large cap portion. So
exactly.
Like if you just do like an S&P for your entire portfolio, I mean, is that diversified? Yes.
Kind of.
It's diversified in the sense of you're in the world of large cap US.
Yeah.
One company's not going to make or break you. I mean, you'll see companies that have a bigger impact.
Sure.
Like your big $3 trillion market caps are going to have a lot bigger impact than your $1 billion market or your $50 billion, $100 billion market caps. But it's still going to be diversified enough. So if like one company goes under, it's going to be replaced in that index at that point. But it is going to be where, again, if you have mid and small cap outperform, emerging market, developed markets outperform, you could see S&P 500 underperform for a long period of time. But again, that's why it would be complemented by another, like a Russell 2000 index, or be complemented by an international index at that point. And I think too, for a lot of investors, where like most of their wealth in their 401k or most of their wealth is in something that's just like a employee sponsored plan, you do have target date funds, which I know We have slightly different views on target date funds. I tend to be a little bit more favorable to them, just depending. But funds where if you don't want to do this, you're not at a point where your financial plan warrants the complexity to work with an advisor, and you say, hey, I want to make sure like I can do something where I'm not taking on too much risk. I'm not going to hurt myself from a financial standpoint. A target date fund's a great way to use it. It automates it. It gets slightly more conservative. It's diversified. Now, again, we can argue into, are some target funds better than others? Yes, definitely. But it is one of those things where on a 20, 40 year time frame, it's going to be something that if that's just where you're at and you're like, hey, diversification sounds like exactly where I want, but everything's in a 401k and I already have a plan or whatever, targeted funds be a pretty good option at that point. And then two, you're not worrying about, all right, did I go to cash? Do I need to trade this? Do I need to rebalance this every year? When again, you can worry about the things that are important, like your family, your job, what's going on this year, and you can automate the part of your life that can be automated. But again, I think it all comes down to goals based. Like
goals based and patience. I think in the past few years, it's really easy to see a lot of progress in big companies, big names like NVIDIA. And if you're investing for retirement or any other goal, it's probably going to take a little bit longer than 5 years for you to see the ultimate benefit of diversification.
Yeah, and it's so even if we look at let's look at this. So even if we look at here, so S&P 500 over the last 3 years has had an average annual return of 9%, 9.9%. NVIDIA's been nuts at 87, Apple 16, Microsoft's 13, Amazon's 3. So even if we're talking like those big four companies, one of them is dramatically underperformed. We go last 5 years, Amazon's still underperforming. So it's not just you can pick a big name that you know that the company does really well.
Big name's going to beat the S&P.
It's not necessarily that way at all. Yeah. So we go, we add, and let me do. If we had Tesla in there, so the other kind of big one that gets talked about, last 5 years, it's beat the S&P. Last 3 years, it's negative. So like you had a negative return. So a lot of it too is like you hear all these great returns, and I think you get this fear of missing out. And diversification is like the king of you always feel like you're missing out because you still experience down markets. Correct. It's not like diversification is a magic pill that in 2022 you had an upside return. It's not. No. You just limit those harsh edges. Yes. So you always feel like you're losing when the market's up.
Somebody else is going to be doing better than you.
All the time.
Yeah, all the time.
You always, because mainly, and again, you only hear about people's winners, but two, you never, I think the thing is like, not just that you never hear about people's losers, but you never hear about when they got in. So there's been a few reports that have looked at fund returns compared to the average investor return in that fund. And what they look at is like fund flow. So when money comes into the fund based on what the performance was. And they'll look at, I think the one I've seen most recently was like on ARK, which had phenomenal returns through like 2020 and 21, where the fund had phenomenal returns, but they looked at the average investor, and the average investor was flat to negative because they got it like by the time you hear about something like that, you're usually already past the peak of it. Yep. So like for most people, like, oh, it'd be great if you got in at the bottom of NVIDIA, but no one was talking about how great their NVIDIA holding was when it was 70% down. You hear about it in 22 or in 24 after it's already had a gangbusters year, and you get in and you miss a huge portion of that. So then you might say, hey, I have NVIDIA, but you might only be 20% up rather than 520% up. At that point. So it's one of those things, you're always going to have that FOMO. It's just the reality of being diversified, which kind of sucks in a certain amount of way, but you can kind of pout all the way to a successful retirement. That's what I'd say. It's like,
I think maybe the next video we do needs to be on just the behavioral side of investing. And how do you use, how do you make sure that you're aware of the behavioral biases that can make you make some poor decisions with your investment approach? And then how do you make sure that you're using time-tested principles to guide your investment approach instead of emotions or what's going on in the market or the news or anything like that.
Yeah, because I mean that's the thing. I know I've seen it.
That's probably the biggest determinant of
that's the,
success.
And that's the big thing with diversification is it can limit those bad decisions because it only takes one or two of those to wreck an entire financial plan. It only takes moving to cash at the wrong time and staying in it for too long to be $100,000 mistake when you could have just been diversified, not had the massive up and downs, but been in a place where you could at least have stayed invested. Like it would have been enough moderation to where, yeah, maybe you didn't have the massive return, but you also didn't have the massive sell-off that you then panicked and panic sold. So like what we see a lot is like someone will sell off in like the bottom of 22 because they'll be panicking, but not get back in 2023, and they'll miss the entire upswing year. Whereas if you just said, all right, well, rather than being that huge percent down, maybe I was only down 12% or 16%, and they could stomach that, and then they got the whole recovery because they stayed invested. So again, that behavioral side of it, like we're talking about just diversification over a long period of time can work, but part of that is just preventing yourself from being your own worst enemy to your plan. But guys, thanks for listening. I know this probably seems like a roundabout conversation. I know when I talk about diversification, it sounds like I'm saying the same thing.
Yeah. Diversification's good.
Yeah.
That's pretty much the whole conversation.
Yeah, good. Just do it. But we'll link to this chart in the show notes. But again, check out the rest of our videos, and thanks for watching.